Most of the major banks don't have programs for self-employed individuals. They don't cater to them, but there are programs out there where you don't always need 20% down. So for those that are self-employed that have gone to your major bank and been declined, that's not surprising, but you're not lost.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm a level 2 mortgage agent. I'm joined, as always, by Mr. David Warren, mortgage agent level 2, owner at Referral Mortgages. We're back. We're buzzing. It's summer. It's spring market. It's hot as heck outside. And today is June 9th. Dave, mid-June. It's absurd that this year is almost half done. There's a lot going on. We want to give a quick shout out to all of our listeners, all of our sponsors, and actually our new followers. We got a lot of new listeners, and we actually got an influx of questions, which, you know, people throw questions on the YouTube channel, but like direct questions to our email. So we're going to touch on a few of those today, and we kind of figured, you know, let's dedicate this episode to the listeners, to answering questions, to stuff we deal with every day. So what do you think, Dave? How is your week, and what are you seeing today? What's going on in the market?
Well, today we're recording in the afternoon as opposed to the morning. So basically through the most of the day, and it's been a hell of a day. Busy as all could be. Number of, bunch of purchase agreements, again, transfers. It's definitely busy, but to be expected, like we were talking about before, that delay in the spring market, kind of rearing its head in June right now. But yeah, all good things.
Yeah, I agree. Lots of conversations, lots of people, I think, excited, a lot of people worried. And, we talked last week about people walking away from homes after inspection. I actually saw it one more time after we recorded last week, but now, we're 4 days sober, 4 days without any of that happening. So I think maybe we're out of the woods, but it was a bit of an anomaly. I think people this week, at least from, over this past weekend, I did get a few purchase agreements in, but not as much as, a week or 2 weeks ago. I think it always happens in cycles, right? We get one big wave, things happen a bit, and then there's another big wave, typically, right after school ends. Like now, everyone I talk to, it's like, oh, our daughter's got graduation next week. We're getting ready to go up to the cottage at the end of the school year. Like now people are starting to think of like summer months. So the spring market, I think, will trickle into the summer, but it's not going to be as aggressive. I think we'll have one more big push, 1 week probably, of everyone trying to buy that last week of June or early July. And then I think we're going to see it probably stagnate till, late August, mid-September, when everyone's back in school. It happens every year.
Yep. No, agreed. I was surprised to see my first September purchase agreement today.
Yeah. Yep. Yeah, same. Yeah, it was weird. I'm like, September, that's years away. It's like, no, we're actually 90 days. We're 90 days away from September. Pretty insane. So some of the stuff we saw, Dave, like the questions were very interesting because for us, obviously, it feels very, I don't want to say generic, but it's like these are conversations we have every day. So it does feel very familiar, maybe is the better word. But the first one, which kind of speaks to your point about renewals, the question was, my rate is renewing and I have no idea what to do. Now, we've talked to this person since we got this email, so they're not sitting there waiting for anyone listening. Like they're not hanging there waiting for us to talk about this a week later. We have already spoken to them, but for anyone else listening, Dave, like if someone says to you, like, I have a renewal in September, I've never renewed before, like, what do I do? Like, what's kind of the starting point? How do you approach that? And what's the goal with that conversation?
Yeah, it's a great question. I mean, really, any of the conversations I have, they always start out with, what are your plans and goals? Are you, how has it been the last 3 years, 5 years in the home? As you're coming up for renewal, I kind of use the sports adage, you're a free agent, if you will. You're not tied to that one particular bank. You can switch teams without any sort of penalty or anything like that at maturity. And so really it's a time to kind of look back at how things have been the last, period of time, how the house is treating you. Is it something where you're looking at needing to grow at some point? Are you planning to stay in it? Or is there any debts that need to be consolidated at this time? Any renovations that are on the horizon? Anything like that? And kind of just really dive into what their plans and goals are on a go forward basis, how it's been. And really starting there as far as the conversation. It's a mix. I would say it's a mixed bag between people wanting to renew dollar for dollar and continue along their same amortization, or that they are looking to consolidate some debt or pull out some equity or add a HELOC so that they can do some renovations down the line. But certainly starting with that conversation of, what are your plans and goals? Similar to what we kind of the same conversation kind of that we have, a little bit different, but when somebody's buying is the same similar type of conversation. Like, what are your plans and goals and hopes and dreams with this property you're purchasing? Is it something you're planning to staying in long term? Because that also dictates that that term length maybe that they're going into. If they're planning on, maybe it's a rental property and or they've converted it since they bought to now being a rental property, and they are thinking of, maybe in the next year or two, maybe then we'll look at selling or something like that. So kind of being cognizant of that to before getting into any sort of rate conversation.
Yeah, I think the biggest surprise for people renewing when we have those conversations is the fact that it's much like buying a home, right? Like the new lender doesn't know you from Adam, right? So they need to know, like, what's your income? What's your credit history? How much equity do you have in the home? What do you do for work? Like, they need to know everything so that they are assessing it with they are a fresh set of eyes, right? So people often come to us and they think, oh, well, I already own this home. Like, why do I have to provide all this again? It feels sometimes overwhelming. But I think once we explain to them exactly that, like if you're the lender and you're lending someone $500,000, you're probably going to want to do your due diligence. You're going to want to see, like, what's their credit score? How likely are they to repay this on time every month for the next 5 years? So I think the way to approach it, at least mentally for clients, is I am going to save, let's say, I don't know, you've been offered 449 and we can get 429 or something, right? You're going to save thousands of dollars over the next 5 years. It's a small price to pay to provide updated letter of employment and pay stub. Like, it's really not, it might feel
Mhm.
overwhelming, but I think we do a really good job. At least brokers, I think, good brokers that are make it seamless should make it feel not overwhelming, right? It's like, yes, I need these small amount of documents and I'm going to take everything from there forward and I'm going to handle the transfer from one lender to another. You're really going to have to do nothing in the process. There's obviously small things needed, but generally speaking, it's really just to assure them, like, you're going to get the best rate, you're going to get a great product, and I'm going to make this seamless for you, and that's really, like, I think once you explain that to clients, it alleviates that fear of the unknown. Like, they just don't know. I bought this home 5 years ago. I've never renewed my mortgage. They come into the conversation oftentimes stressed, anxious, unsure of what's going to happen, fearful, like thinking they're going to get a worse rate, or they see the headline that, payments have doubled and they're fearful of that. Like, there's all these things that come with the conversation before they even talk to us, so that we have to
Mhm.
kind of work through and figure out, okay, what is that fear? What's it based on? And, like, how can I explain this so that it seems as easy as it actually is, you know?
Yeah, and in that renewal conversation, it's important to also look at not being hung up necessarily on what the amortization is. When you're renewing dollar for dollar, staying on that same amortization and going from, a rate in the low twos or high ones to, in the low fours or even a variable at 3.6, like increasing 50%, those payments will inherently obviously increase. However, there are things to be cognizant of what is your actual budget. Are you wanting to keep the payments around what you're paying now? Is that what you're comfortable with because all other living expenses have come up? If that's the case, we can look at lengthening out the amortization and in some cases and really kind of match up that payment to what you're more comfortable with within your budget range, but allowing you to have the flexibility that you can voluntarily increase your payments once you've kind of stabilized to get you back to that same amortization if you wanted to, or, or even just moving from monthly, what you were on before, to accelerated biweekly, but kind of keeping it within that budget. And that might, and that's going to shave off some of the AM as well. But it's important to really kind of start the conversation not with what's your best rate, because just like a purchase, all things are not equal, and it's a matter of what are you looking at doing. If you're carrying $40,000 in credit card and line of credit debt at 20%, then you want to consolidate that. Like, it's not in your interest to carry that. So yes, you might not want to lengthen amortization or increase your loan. Well, what you're going to be paying, is it realistic you're going to pay that loan off at that high an interest rate? How much is that actually costing you? So you can really kind of look at what that cash flow savings is as well.
Yeah. And to that point, and kind of to the second question that we got,
Mhm.
I'm going to wrap this all into one really long-winded answer here. But the second question was, should I lock in now or wait for rates to fall? Wait for rates to fall more was the way it was positioned. Which, I mean, ultimately, this is what we face every day. This is probably the number one mortgage question being asked today, with fixed versus variable, the timing of rate cuts, the uncertainty of the bonds and everything overseas. Like, This is a very common question. And the way I like to position it, and I think we both are, having been in the industry long enough, I think we're both very pro variable when it makes sense. Obviously, you have to be comfortable with it. You have to be willing to take on the rate risk and everything of rates going up and so on. But in this environment right now, where we're seeing variable rates, in most cases, 0.5% or more lower than fixed, there's so much flexibility there between increasing your payment voluntarily, which made me think of this because of your comment. If you're taking a variable rate that is 0.5% lower and your payment's $200 less, just keep it at the payment it would be if you had a fixed rate. Like, just keep that extra $200 there, because not only is that prepping you that if rates go up, you already have that buffer built in, but also that extra $200 or whatever it is every month is going directly to the principal balance. So now, instead of it being 25 years for your total mortgage, it's going to be whatever, 23 years or 22 years. Like, you're going to actually be paying it down even faster, having a lower interest rate, and building in the buffer that if rates do go up, you're already ready for it because you're already making that increased payment that you would have been making on the fixed rate, right? So you're getting the interest benefit, the payment benefit, the principal pay down benefit, and really, there's not as much risk because you've already prepped yourself for that increased payment if and when it happens, right?
Yeah, no, it's a great strategy. It's really, taking that and then combining it with like what we've talked about in previous episodes of, being able to lock in that variable rate to a fixed rate mortgage at any time. So if
Mhm.
you're of the
Yeah.
belief that fixed rates are going to keep coming down, when this conflict hopefully comes to an end, we get oil flowing and all that, you can convert it at a later date. So set your payments, like you were saying, set your payments at that equivalent fixed rate, take advantage of that interest rate savings, and watch as well for the fixed rates to come down and take advantage of that strategy of locking in that variable rate to a fixed at a later date once they've come down from where they are now.
Yeah. Yeah, I totally agree. Like, there's so many benefits. I even had a client that right now they're basically making a lateral move, and I don't know if they listen to the show, but I won't get into specifics. But basically they're selling a property that is equivalent value to what they're buying. But it's a lateral move, but different location, closer to their kids. It's like it made sense. But the new place they're buying requires about 200,000 renovations. So we had this conversation of, do they get a HELOC and basically like a home equity line of credit on that new property and just use the line of credit as they see fit? Or do they just hold back 200,000 from the proceeds of their sale and just, use that for the renovations? And if they have anything over, apply it as a lump sum. There's all these strategies. And this is the thing, you can't paint everyone with the same brush because every single client's situation is different. Their goals are different. Their risk appetite is different. And that's why it really is important to grasp exactly what your client's situation is, what their goals are ultimately, and then tailor the advice towards that. So even the question of like, do I lock in now or wait for rates to fall? Well, it sounds like a really easy question, but it's not. There's probably about 10 follow-up questions we'd have before we can even answer that one that they have. So there is a lot of nuance in our industry. Every single client is different. I say this to clients like, well, they ask kind of a simple question of, if I add a co-applicant, is this going to strengthen my pre-approval? Like, well, it depends. Like, there's no easy answers, right? It depends on that person's, like, the same way your income matters, their income matters, their debts matter. Like, what monthly obligations do they have? People often also think that, like, if they say to us, oh, well, my colleague just got 3.99% and they have the same job as me, or they bought a house that's the same price as me, or whatever. But like, that's such a broad comment, right? Like, down payment matters, income matters, location matters, like everything matters. So like, you could be in the same job at the same employer for the same tenure as your colleague, but their income's going to be slightly different for whatever reason. And their debts are going to be obviously totally different than yours. And their down payment's going to be different and
And
coming
their
from a different
credit.
source. And their credit, like, everything's different. So like, you might think you're the same, but you're not at all, right? Like, you have the same employer. That's about where it ends. Everything else is different. So like, for us, it's, clients often ask very broad, high level questions, and they get sometimes a bit frustrated by us having to dig into that. But then once you explain it, it's like, oh, okay, I understand why you needed all that info. But for most people, it's like, listen, this is my income, this is my down payment. What can I buy? And it's like, I can't tell you, like, it's very nuanced. So yeah, should I lock in now or wait for rates to fall? That was kind of the leading question here. It depends. But ultimately, it's always, I would say it's better to lock in now because we say this on the show. So I apologize if this is redundant. But if you lock in now and you close in 120 days, most lenders are going to let us to what we call like float down the rate. If the rates go down between now and your closing date, lenders will allow us to request their lower rate if they drop rates. But if rates go up, you're locked in, right? So if we lock you in at 4.34 today on a 5-year fixed and rates go down to 4.19, we can get that. But if they go up to 4.49, you're guaranteed the 4.34, you know? So there is always an advantage, I would say, of locking in. Like you're never going to lose by locking in too early, I would say, but you can get a lot of benefits of locking in early.
I say you really protect yourself from risk locking in early. So if you're locking in 120 days out from your maturity date, if rates go up, you're protected. If rates go down, we're able to take advantage of those lower rates. So it's really only in your best interest to lock in early. And number one, it's off your plate. You're not having to worry about it, but it allows us also to continue watching what's going on.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Even the best photographer can't hide drywall dust and paint splatter. And every day you delay listing could mean missing peak spring pricing in Ottawa. A to Z Cleaning Expert gets your property truly photo ready. Don't risk going to market half ready. Mention TowRep at atozcleaningexpert.com to receive priority scheduling for your next listing.
Circling back to kind of that, we're talking about the renewal process and what those conversations look like. After you've kind of gone through all of these questions about what they're doing and all of that, then it's kind of, really, I always instruct people to first and foremost, ask your bank that you're with right now what they're offering for renewal. Because if you're looking at renewing dollar for dollar, staying on the same amortization, then you might as well look to compare apples to apples. So ask them first and foremost, what are you able to offer me for a renewal? Take that, and then I'm able to look at, okay, this is what they're offering you. Great. This is what we can do to the marketplace of like helping that situation out. Because like you said, we are having to collect updated income documents and things like that. So if it's a matter of they're being super aggressive, we'll just be honest and we'll tell you, hey, this is an amazing rate that they're offering you. They're being hyper aggressive. And I tell probably 3 to 5 people a week this, like, they're being hyper aggressive. Just take that offer. Like, you're not going to be able to find any better. And then other times where it's like, no, they're like, we can certainly help you do better. Not only save you money, maybe it's getting as well, like some cash back, like a cash incentive from some institutions are doing that as well, things like that. So we're looking at like different scenarios as well, but it's really kind of looking at first and foremost what they're offering, making sure that that's the lowest that they're able to offer, and really just making sure that that switch is going to be worth it for you, worth the legwork. And then from there, really, we're going out to the over 40 different banks that we're dealing with and that we have partnerships with to find you that lowest rate and using that renewal offer to help that process as well.
And for any newer agents or even any mortgage agent who's listening to this, like, it's always a good practice to ask that in advance. Like in that first conversation, just ask the client, have you spoken to your bank? What are they offering you for their renewal? Because a lot of times you can basically realize in the first minute that they should be renewing with their own bank. So it's, like in the beginning of our career, we'd get the documents, advise them, walk them through the process, get the approval. And then they walk into their bank and the bank's offering them a 0.25% lower and, hey, we're going to go to our bank. It's like, okay, great. So you're 2 weeks down the road of working and so on. I would say that probably 50% of renewal conversations, I'm telling them to stay with their own bank because it is the best option. Like that is our goal, is to find you the best lender. And oftentimes, if it's a repeat client, we place them with that lender. So we obviously have confidence in that lender. It's not as though we're trying to move them away. Like, we're happy that you're still
Mhm.
happy with whoever that lender is. But if it makes sense to move it, then like we're going to do what's in your best interest. And oftentimes, like I said, probably half the time where they currently are is offering them an aggressive rate because it's cheaper for a lender to retain a client than acquire a new one. As far as like that cost of acquisition, it's much easier and much more efficient for a lender to keep a client and offer them a slightly better rate than to go out and spend thousands in marketing or whatever, hard to quantify, but it does cost thousands to acquire a client. So why would you like, why not just keep the ones you already have happy, And that to me makes perfect sense. And I'm the first, like, I'll tell clients that. I have no problem doing that. And I know you're the same, but I'm saying there are agents that will
Yeah.
not have that conversation and just try to go through the whole just force it through. And that's sometimes when either your client loses trust in you because they're like, why didn't you tell me I could just get a better rate elsewhere? Or it's just very disruptive to you because you do all the work and then they end up leaving at the 11th hour and you're disappointed that you did all that work and so on. So I mean it's twofold. It's a benefit to the client and it's a benefit to yourself and your processes and your workload.
Yeah. And it really ensures that you're being transparent right out of the gate. As far as for clients, you're being transparent. Like if you're somebody that right now that's listening, that's up for renewal, you're being transparent to the person you're working with of, yeah, you've gone out, you've figured out what you can get for renewal, you provided that so that that individual that you're working with is not, spending all this time for nothing, because we aren't, like, mortgage professionals are not salaried positions. And then on the mortgage agent side is, don't be afraid of the bank that they're currently banking with. At the end of the day, it's about the client to be an advocate for them and make sure they're getting the best rate, the best products, the best service for them. And part of that is sometimes we're not able to get that best rate because they have a pre-existing relationship with that bank, and that bank that they're with the mortgage, since you place it with them, maybe they got a checking account, maybe they have a credit card now, maybe they have a line of credit or a car loan. They want to keep them as clients or maybe move some investments. And so they're going to sometimes be more aggressive than a net new client. So certainly it's important to be your own advocate, and then also as a professional to be an advocate for your clients.
Last question, Dave, and then we'll call it a day, but this is an important one and something we also see. I'm self-employed and banks keep saying no. For anyone who's thinking this, like, it is often discussed that I'm self-employed. I just got my license. I just got incorporated a year ago. Nobody will approve me. Like, how often do we see this? And like, just from a very high level, maybe you can speak to like any business owner, contractor, commission salesperson, gig workers. There's so many of them now. Like, give them a sip of the fire hose. Like, how are we able to help those people?
Most of the major banks don't have programs for self-employed individuals. They don't cater to them. They look at just their 2-year claimed income average on their tax returns, which obviously doesn't show the full picture of what they're earning. So there are, of those banks that we work with, there are, the big banks like the TDs and Scotias and BMOs of the world, to mortgage focused banks. These are Canadian Schedule A banks. They just focus on mortgage lending in Canada. The big banks don't cater to self-employed individuals, but these mortgage focused banks do. And there are programs out there that are, insured programs. So through CMHC, Sagen, Canada Guarantee, where you can, with less than 20% down, maybe your gross revenue as a landscaper is, 250,000. And you only claim 50,000 after deductions, and your truck is paid for by the business, and that comes out as a deduction, and your gas and all of that. So you have stuff that is drawing down your income, but it's stuff that you're also using. So you don't have that personal truck expense, so to speak.
Mhm.
So there are programs in which we can state your income, if you will. It has to be reasonable, depends on what your revenue is, what your net income is, what your claimed income is. It has to be reasonable based on that industry. But there are programs in which we can leverage those business for self specific ones to get people across the finish line. And we do it all the time with restaurant owners, like you said, with landscapers and contractors, things like that, where you don't always need 20% down. If someone does have 20% down or more, then there are other programs. If you're incorporated, we can use net income of the business, plus what you've claimed as income. We can use, look to net worth programs. We can look to bank statement programs. So with alternative lenders at 20% down or more, we can look to just income based solely off of 12 months business bank statements, looking at deposits and regular recurring expenses, again, to come up with your income. So for those that are self-employed that have gone to your major bank and been declined, that's not surprising, but you're not lost. Speak to an experienced mortgage professional, mortgage agent that has access to these specific programs, and they'll be able to help you get qualified.
Yeah, the one thing I wanted to add, perfect summary, and I think that covers most of the programs. The one thing I had recently that is another good example is that someone previously had worked for a company in a specific trade. Like they were salaried, they made really good money. They've recently gone out on their own, exactly the same field, but working for themselves. We were able to have the lender look at their last 3 years of T4s, their current statements and invoices to say, okay, look, they made 110,000 on average the last 3 years. They're on pace to make 115,000 on their own this year. We now have 4 years of comparable income, and it seems like it's going to be consistent and it's going to continue. So they made the exception, right? Because of the fact, yes, he's newly self-employed, but he's been in this field for 10 years, and we have the same income and it's consistent and there's some continuity there. That's what lenders care about. They want to see, like, what is the likelihood that the income they made last year is going to continue now and moving forward, and if it's a contract, sometimes they'll make an exception. If you're self-employed and you have a whole bunch of retained earnings and upcoming invoices or accounts receivable, like all of these things can be factored into it. But at the end of the day, we need to be able to paint a very clear picture as to what is your personal financial situation. Like the more we know, the more we can tailor the solution to your needs as a client, but also the more we can tailor this story to the lender's needs so that we can say, look, I understand your guidelines. This is what you want in a client. This is why I think that Dave fits into what you're looking for. Yes, we need an exception on this, but everything else checks out. And we kind of go to bat for that client, right? And say, this makes sense to me using my lender hat. Please make that exception and see it from our perspective as well, right? It's a give and take. And it kind of speaks to your point about working with an experienced broker. That is actually really important because we have been over these things with lenders. We've made these sorts of exceptions make sense and work. And the lenders know that as well. So they know that when we're submitting a file, we know what we're doing. We know how to structure it. So I think it is important to have that conversation early. But if you're self-employed, you can still buy a house. That's the end of the line. We can help you. And where the bank says no, at least have that conversation with an experienced broker so you can see what your true options are and then make an informed decision from there.
And I do want to clarify that the programs we're talking about are programs for A lending. Like there's still AAA banks that we're talking about that have these programs that are for insured and conventional. Then there are the bank statement programs are on, you got a couple tiers of lenders. They are for your alternative lenders where rates are a little bit premiumed. However, that premium is offset by the fact that somebody might be leaving funds in their corporation and invested through the corp at a lower tax rate instead of drawing them personally. And we can still work with those bank statements. So it still makes sense to sometimes have that little bit of a higher rate to save on the taxes. So again, like Paul said, just speak to somebody that knows those structures because it also can play into avoiding having to pay an exorbitant amount of taxes unnecessarily. Like you might be going into your bank where they're just telling you, oh, well, you're drawing only 50,000. Well, if you want to qualify, you need to start drawing 100,000.
Yeah.
And then you start.
Yeah, people do it. And people do it.
So they start claiming that 100,000 or what have you and start paying. Now they're in a different tax bracket. Now they're paying a substantially more amount in taxes where they could have just gotten that deal done with an A bank, keep claiming that 50,000 and using those self-employed programs where we can state your income at 100,000. But
it's a great point, Dave.
Well, sir, shall we, I think we're getting to that time. Should we slide in some mood boosts?
You know it. I got 3 today.
Boost me.
Here's some boosts. Number 1, why did the Wi-Fi break up with the computer? It found a better connection. Seemed kind of obvious. I mean, it's like just write the answer in the joke. Number 2, why don't trees take the bus? Because they can never decide on a route. And number 3, last but not least, to whoever stole my antidepressants, I hope you're happy now.
Look at that. Rim shots.
Yeah. Oh, yeah. No, we're buzzing. Thank you, everyone, for tuning in. Toe Rep every Wednesday, 10 a.m. We're here. We'll be back next week. Be sure to check out all of our socials. And thank you to our amazing sponsors. Thank you to you for listening. Thank you, David, for being here. We'll see you next time.
Deuces.